welcome once again, students. I hope you have watched my last video on the monetary policy tools instrument. There we have learned about few instruments. Again, this is the second part of those instruments which were left in that video. So you can see here in the screen that we were discussing quantitative tools and we were done with the repo rate, we were done with the reverse repo rate, and we were also done with the open market operation. So just a recapitulation of the topics. Repo rate was what? Repo rate is the interest rate at which the commercial banks borrow short-term funds from the RBI in return of government securities to it. Reverse repo rate was what? It is similar to repo, but there the borrowing and lending party changes. There, the Reserve Bank of India borrows short-term funds from the commercial banks in return for their interest rate, and also it keeps government securities as mortgage for a short period of time. That was reverse repo rate. Now here, first in this video, we will learn about what is standing deposit facility. Standing deposit facility, SDF in short, it is equivalent, not equal to reverse repo. It is equivalent to, but there is a short difference. Okay, in reverse repo, the Reserve Bank of India borrowed money from commercial banks for a short period of time, and in return it kept government securities as mortgage. All right, now here a problem arises. Key, the amount of government securities the RBI has, up to that extent only commercial bank will lend the RBI. But if the situation demands more absorption of money from commercial banks, then these government securities will be insufficient. All right. So what the RBI decided, let's do one thing. Let's get away with this. Let's get away with the system of government securities and let's give commercial banks little bit more interest, but no government securities will be given to them. The interest which were given under reverse repo was less, and now the interest under it will be more, but the government securities will not be mortgaged, and as much as money the RBI wants, it can absorb from the commercial bank. This system of absorption is known as standing deposit facility. All right, now see another thing here. Here repo, reverse repo and standing deposit facility, they are directly impacting the flow of money, the flow of liquidity. What does liquidity means, or what does liquid means here? Liquid means cash, and liquidity means availability of cash. Availability of cash. So these three are directly impacting the availability of cash in the economy. So these three are known as the liquidity adjustment facility, LAF. LAF corridor. Next, open market operation we have done in the last lecture, that when we talk about the government securities where the government issued to the public or institutions, whether RBI or commercial banks or any other financial institutions, the government takes money. These government securities are what? They are transferable, they are marketable, and they are negotiable. So the government securities which the RBI has, it can sell to the commercial bank. The commercial banks, the government securities it has, can sell it to the RBI or any other banks. So when the RBI finds that there is a requirement to absorb money from the economy, the RBI sells the government securities to the commercial banks and take the surplus money from the economy, and vice versa. When the commercial banks needs money, commercial bank can sell their government securities to the RBI and take money from the RBI and give loan to the public at a lower interest rate. So that system is known as open market operation. All right. Now let's come to marginal standing facility. Now, what is this marginal standing facility MSF? Okay, Ki- this repo has a limit. What limit? The government securities are the limit, or up to a limit, the RBI will not give money to the commercial banks. Now, if a scheduled commercial bank has a special management account with the RBI, so the RBI may grant more money, all right, by dipping into the SLR. Now we have to know about two more terms, that is, what is CRR and SLR. CRR stands for cash reserve requirements or ratio. SLR is the statutory liquidity ratio or requirement, SLR. All right. Now, net demand and time liabilities of commercial bank. Here, liabilities are nothing but the deposits of its customers. Liabilities are the deposits of its customers. Demand liabilities or demand deposits are what? The account, savings account money or the current account money. Time liabilities or time deposits are fixed deposit account or recurring deposit accounts money. So this net, इन सबको मिलाकर इसको कहा जाता है नेट डिमांड एंड टाइम लाइबिलिटीज, इन शॉर्ट NDTL. Now RBI has made a rule for every commercial bank in India from in a any point of time, the net demand and time liabilities of the bank, from it a certain percentage of cash shall be deposited to the RBI. The amount of deposits the commercial bank is having at a point of time, from that deposit a certain percentage must be deposited to the RBI, and another percentage shall be kept with the commercial bank itself in the form of gold, or maybe in the form of cash, or maybe in the form of short term marketable securities. From this from this fund, it cannot give loan to the public. The commercial bank is a separate fund. From this fund, the commercial bank cannot give loan. And from this fund, it is already with the RBI. From there, it cannot give loan. This money is with the commercial bank itself, but it cannot give money. That's a strict guideline by uh, RBI. Now, this amount of money that is with RBI from the net deposits is known as CRR, that is cash reserve ratio, and this requirement, this percentage which is with the commercial bank itself, from where the commercial bank cannot grant money, is SLR, statutory liquidity ratio. All right. Now, under marginal standing facility MSF, the RBI allows a commercial bank कि चलो from SLR you take certain amount of money from for your operation. Actually, from there money cannot be withdrawn, but it is allowing, RBI is allowing, चलो ले लो यहाँ से, take money from there, but in future you have to pay an extra penalty charge to the RBI. All right, this facility is known as marginal standing facility. Hence, we say marginal standing facility is a loan over repo limit by dipping into its SLR portfolio. All right. So these are the monetary policy tools. What are the tools that we have studied today? We have already studied repo, reverse repo. Today, standing deposit facility, open market operation, marginal standing facility plus CRR and SLR. So hence here we complete our all the tools under quantitative monetary policy tools. So There are more tools under qualitative monetary policy tools that you will see in the next video. Thank you so much. Stay tuned. Best of luck.